Good afternoon. Happy 1st of September. Okay. Don't forget, we're now 18 days away from the Fed, if I'm not mistaken. Okay, so it's coming. The Fed's coming. What we're going to do today, we're going to start fundamentals, quick through the economic calendar. I'm then going to bring you up to speed with the yuan, the Shanghai, and China. I'm then going to show you something very interesting about China. And I'm going to get you guys to, again, move away from this idea of thinking what the newspaper's telling you and what the market commentary is telling you, and get you to think forward, not backwards. We're going to talk about corporate issuance. I'm going to explain it to you. I'm going to explain to you how swaps work. I'm going to show you the trade opportunities that exist over the corporate issuance month of September. We're going to have a quick look at a market in play, which is the US 2-year. We talk about gap opens, and something I've noticed, a pattern I've picked up on. We'll also have a little bit of a ladder. And then quick talk about iron reversals. Our quiz question for today: what is your process-oriented goal for tomorrow? Okay, we went through this last week. I got you guys all for one day to try and enter aggressively our market. Okay, make sure, guys, every single day, this should be in your diary. What is your process-oriented goal for tomorrow? That should be the most important part of your debrief. Every day, guys. Not just today, not just tomorrow. Every day you should achieve something. That's how you get better. And then we'll have a little quick motivational moment. And don't worry, guys, I know it seems like a lot, but it's not that much. We won't be long today. Okay, so headlines today on a Tuesday morning: China data hurt stocks and commodities. China data, they're referring to PMIs. Okay, it's the first data we've had since the PMI devaluation of the yuan, or the panic about China. It's the first bit of growth-related type data. Now, the number came out as expected. Okay, but let's read the way the newspaper article wrote it. Okay, remember, journalists get paid to create stories. So, China's official manufacturing PMI slipped to 49.7, so it slipped last month from a reading of 50 in July, falling for the first time since February below the level of 50 that separates expansion from contraction, and the weakest showing in 3 years. Now, does anything of that tell you that it was expected to slow to that pace? Does anywhere in that whole first sentence tell you that it was expected to be at that pace? Okay. That's a summary of what journalists do, guys. They have to create the story. 3 years, the lowest. It's below manufacturing. China's screwed. Copper, oil, everything's selling off. End of the world's coming. Okay? That's what journalists do. That's why we as traders read between the lines. We don't take what they say. Okay, so again, he's leaning on the fact that because of the PMI, that's why the yen was rallying, the gold was rallying, the treasuries were rallying, and the equity sold off. Okay? I beg to differ. It's not got to do with the PMIs, guys. Okay? What it has to do with is this continuation of the risk-off theme that we've seen in the equity indices since when? Not last week, not since Black Monday, but the week before. So this is the third week running in which we are in a short-term, a downward move across equity indices. Okay, make sure you understand that, guys, because when markets are driven technically, right, they last a lot longer than when they're driven by one-off fundamentals. Okay. Make sure you understand it. So let's quickly turn our attention and talk. Let's look at China. Let's see what China's looking like at the moment. So, first thing I want to put up, shut that light off, please. Okay. Make sure every morning, guys, when you get in, because China is so important, because the Shanghai is leading, Asia's leading Europe, make sure you have a look at the price action on the day in the Shanghai. So that's today. Okay, as you can see, the Shanghai opened down. So it opened down negative 2% from the close on Friday. From the close of yesterday. It then sold off initially before doing what? Coming back to attempt to fill the gap. Did it leave a gap? Yes, it did leave a gap. It then settled lower on the day. Okay, so in essence, if we were to draw that pattern, market opens, gaps, drives down, comes back, fails to fill the gap, and settles for the day. Now, if we were trading this market tomorrow, what would you say? We would say, well, 1, we know there's an anomaly and it's a gap. 2, we know, well, the market did get bought up pretty quickly off that low. Okay, and 3, we would say, well, if we took out that high before the gap, we should very likely fill the gap. Do you all understand that basic pattern, guys? Now, it's so important to understand that because these patterns will follow through, not into just Europe, but also into the US. And we're going to have a look at that in a minute. So, there's the Shanghai. Obviously, they're your key points, guys. Today's low is very important, and obviously today's high. If we take out that high, we're going to fill in this gap and likely retest last week's high. Equally, don't forget, we've spoken about this, 2850 as the key area now, guys. It's the point at which the China Central Bank intervened, cut interest rates, cut the triple R. Okay, they threw everything at it to try and stem the flow or stop the losses in the Shanghai index. Right? We get below there, right, we're probably going to see some very, very aggressive downside moves. Other than that, that's all you need to know about the Shanghai. Okay, so let's get back to it. Let's talk about some other fundamentals in the overnight. So very briefly, oil surges 25% in 3 sessions. Is that important? Do we want to pay attention to that? Well, heck yes. If a market's moving 25% in 3 sessions, we want to pay attention, right? Why? Well, it's simple, guys. Okay, and this is where you have to be switched on as a trader, and you have to learn to navigate your way between markets that are moving, right? What makes, if you look at oil over the course of the year, we've effectively sat in a sideways range between $60 and $40. Okay, and then over the course of the last month, we kind of went all the way from $58 a barrel in a straight line down to 37.5. The market now turned around, reversed, and has now stopped at $49 a barrel. So over the last 3 days, what we've seen is this. Okay, that's what we've seen over the last 3 days. Right, now the reason I'm pointing out the oil fundamentally, right, is because all we're hearing is that, number one, the reason for oil's rapid rally is OPEC. Apparently, OPEC is going to change their entire strategy now because of oil being too low. Okay, now, don't forget, Saudi Arabia came out with an intention last year that they were going to try and regain market share. In other words, they were going to allow prices to drop as low as they can so that any producers that are producing oil at very, very high cost will effectively be squeezed out of the market, and then the very supply, or the people who want oil, will then go to other suppliers such as Saudi Arabia. They gain the market share back. Okay, that was the strategy from the beginning. Now, again, you have to read between the lines. Saudi Arabia is probably the most cost-efficient producer of oil. So why on earth would they suddenly come out and change their strategy? Okay, so remember, guys, the market is saying that this move is being driven by OPEC. Bullshit. Okay, it's been driven because the market collapsed in a straight line, and now someone stepped in to buy the market back up, and everyone is short trying to cover. More importantly, what have we seen today? Okay, we've seen a 7% down move today. So 25% up in 3 days, 7% down. What does that tell us in a nutshell? It tells us there is volatility. The very thing that traders thrive off, guys. Volatility. Okay, have a look at the oil. It's a wonderful market to be trading right now. Why? Because it's doing $5 up, $4 down, $3 up, $2 down. 50 ticks in 5 seconds, 50 ticks in 2 seconds. Okay, yes, you can lose a lot. But if you're focused and you get involved in the right trading areas, you can make a lot of money very easily. It's giving a lot of golden type opportunities. Okay, lesson for the future. You don't have to necessarily trade the same market. Trade the market that's giving the opportunities. Got that? Okay, you guys are all a little bit lucky in a sense that you haven't seen when markets become dead, when they become quiet. Right? Have a look at the Bunds, have a look at the Euro Stocks 2013, you'll see what I mean. Okay, let's move on. That's why oil was quite important. Let's talk about the weekly calendar. Okay, ISM, as you can see, came in a little bit lower for the US today, but again, guys, don't forget, you're going to read in the newspapers tomorrow, equities down in the day, bonds rally as ISM, as manufacturing faults in the US, rate hikes not going to happen. That's the headline for tomorrow, guaranteed. That's what they'll write about. Don't forget, the economy, the recovery in the US and the UK is being driven by who? Not the manufacturing sector. It's being driven by the consumer, which makes up the largest portion of the US economy. Okay, so don't forget that, yes, manufacturing is important, but we know that because of the higher, stronger dollar, right, manufacturers in the US are going to come under pressure. Okay, you understand that. Because of the slowdown in growth in the world, manufacturers are going to come under pressure. But that doesn't mean consumers aren't going to keep driving the recovery in the US. Okay. Now, what I do want to talk about is this very briefly, but I'll get to that in a second in the bonds. Let's talk about the weekly calendar. So, first up today, or yesterday, as you can see, bank holiday. All right, we did have 2 key events. We allocated 20%. Now, the first thing I want to point out, guys, is note the even allocation of risk over the course of the week. 20% every single day. Okay, and you'll understand why as I go through it, why we're doing it that way. So today, okay, we had the first China manufacturing data. We had some mostly manufacturing data. Tomorrow is the US ADP. Now, normally ADP is not very closely watched. It's not a very good indicator of non-farm payrolls. It used to be, but not anymore. So why is it a key number? Well, it's simple, guys. The market is very sensitive right now to the NFP. Okay, so equal allocation. The key points to point out, Monday next week is a US holiday. It's important to note that because, you know what, if the non-farm payrolls comes out as expected on Friday, I'm going to do my trade, bank my money, and go home and have a long weekend. Okay, so expect Friday afternoon to die out very quickly, particularly if the number is in line with expectations. Okay, factor this into your trade setup for Friday. Again, bonds not responding in a typical risk-off fashion. We've spoken about that. Right, this was the first week, obviously we've had China data since the devaluation and rate cut. So again, that's why the PMIs was a little bit more front and center type this morning. Okay, it's the last NFP ahead of the September meeting. All right, and don't forget, good US data will make the bonds go more aggressively down, whereas bad data, for instance, ISM today, what did the T-notes do? Blipped up, sold off. Okay, so again, another piece of US data where the market blips up, gets sold into in the bond markets. Okay. And then it's NFP week, and then the last thing, Wednesday, Thursday, we have very large bond supply out of Europe. All right, let's turn our attention to that. Why do we want to know about bond supply? All right, it's called Corporate Issuance Month. Okay, so in the month of September, in the month of January, and the month of September, we tend to have very high volumes of corporate issuance. Now, for obvious reasons at the beginning of September, because everyone's back from the summer break. Okay, so everyone wants to get the flows going. Now, all I want you to understand about corporate issuance is two things. One, okay, you have an issuer, and I'm going to use the same example as Imran did, Intel. It's a company. Intel phones the bank and says, Mr. Goldman Sachs, I want to sell 1 billion of bonds to the market because I need money. I need to raise some money. So, effectively, Intel sells bond A. Okay, the bank sells the bonds on behalf to the client B. All right. In return, effectively, the way to think about anything when it comes to derivatives is cash flow, right? So Intel will receive, say, $1 billion for selling the bonds, okay? And Mr. B will receive coupons. So he will receive payments every 6 months, every 3 months, whatever it may be. Okay, now, there's a second part. That's a straightforward issuance, guys. Okay, effectively, they sell bonds into the market. Okay, now, what happens is the bank sits as an intermediary, so we'll call it Goldman Sachs, sits in between the institution, Intel, and the client wanting to buy. Okay, so the first example is direct issuance. That's what Imran was talking about. What he was saying is that, in essence, if all of a sudden this Intel deal is going to be sold to the market, okay, then in order for the bank to hedge itself, it has to sell T-notes. All right, because remember, effectively the bank is long the bond. So in order to hedge themselves, they have to go short the treasury and lock in the spread between the two. Okay, that's how they hedge themselves on a direct issuance. You all understand that. Okay, I think you all caught that part. Now, the second part is when you have effectively swaps. Okay. Now, the reason why I want you to understand is because you need to think of the initial deal, which is the issuance, and then the swaps as two separate things. It is two separate deals, effectively. All right? On the one hand, Intel's looking to raise money. On the second hand, where they do swaps, they're looking to manage their cash flow. It's a separate deal. So what happens in this essence, okay, is effectively Intel goes and buys a swap. All right? So they buy fixed rate. So what they're saying to Goldman Sachs is, Goldman Sachs, I'm issuing this bond, okay, of 1 billion, but what I want to know is I'm going to have to pay these guys out every couple of months. But I want to know that regardless of what rates do over the next 10 years of this bond, I want to be able to pay the same amount for 10 years into the future. Why? Because it makes my business easy. It makes my cash flows easy. I know every month I'm going to pay X regardless of what interest rates are doing. Goldman Sachs says, okay, fair enough. I will give you a fixed rate, okay, and I will take the variable rate. Okay, so in other words, the client, Intel, transfers the risk to the bank, okay, in return. So let's say Goldman Sachs is fine. It's going to cost you 6%, Mr. Intel. Right, Goldman Sachs works out that effectively it's actually only going to cost 5%, and they can manage that risk effectively. Goldman Sachs then takes that risk of a variable rate and hedges it into the market. Okay, how do they hedge it into the market? Well, effectively, they now short a swap. In order to balance that short, they need to go and buy up a T-note or some form of a bond. You all understand that? Okay. If I was to do in basic terms, let's say, for instance, a stupid, silly little swap. let's say the US 10-year is trading 1.75%. Okay? So effectively now Goldman Sachs is short yield of 1.75%. Okay, they know they can go into the market and buy it back at say 1.65%. What are they doing? They're locking in 10 basis points of free money effectively. Okay, but remember guys, the reason they get this 1% increment or this difference on the swap is because they're taking the risk on their books. Okay, if Goldman Sachs can't go and hedge out that risk, they still sit with the risk. Every second the rates move, they sit with the risk effectively. Okay, now I know it doesn't seem like big amounts, but when you're doing a $1 billion deal, it's huge, guys. Every increment is huge. It's thousands upon thousands of dollars. Do you understand that? Does that make sense to all of you? Okay, so there's two sections. The issuance, number one, and then the swaps. They swap it. Why? Because they want to manage their cash flow. They just want to have fixed cash flows every single month. That's Intel. They want peace of mind that it's fixed. The bank takes that variable rate and they hedge it out. Okay, you all got that? Are there any questions with that? I need you to understand that. Excellent. So, more important, where are the trade opportunities? Well, it's simple. When you have straightforward issuance. Now, Imran noted, very important, issuance, the swaps tends to be the more likely one. Why? Because most companies want fixed rate. Okay, so effectively, the more important one and the more likely one is they swap it out. So what we tend to see is, buy flow. Now what do I mean by buy flow? Very important. Buyer steps into the market, draw this pattern down. So he buys the market up aggressively, lifts the offer, lifts the offer, lifts the offer, stops, allows someone to sell, allows someone to sell. He then goes back to the market again. Okay, that's what you typically see on issuance. Okay, very aggressive buyer, stops, absorbs the market, then goes again. Once the issuance is done, once the deal pricing is done, the market then turns to slowly drift lower. Note, I didn't go straight down, it slowly drifts lower. That's the pattern of issuance. That's what we have to be switched on for the next couple of days. So where are our trade opportunities? Well, one, we know that we can get stuck in there. We see that straight line bid and the market goes off it, absorb, 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 bang, we in, we hit the bid. We go with the flow. Hit the bid, offer, hit the bid, offer, hit the bid, offer. Nick, 2, 3 ticks, as many as you can, as many times as you can. Okay? Keeping in mind that the issuance times tend to be somewhere around the 3:45 and 4 o'clock. So it'll be somewhere, anywhere in the 15-minute increment, guys, starting from 1:30. So once the cash opens at 1:20 effectively. Okay. The second opportunity is obviously, as Imran said, is once the deal pipeline's done, the issuance is done, just look for a slow drift fade. All got that? That's the most likely option and the one that we will be paying attention to very closely. Okay. In terms of basic issuance, you all know the Intel example. Okay. Very aggressively, the T-notes got sold off quite heavily. Now, I don't want to talk too much about straightforward issuance because, again, it was a very big deal. It was 39 billion. And it's very unlikely you're going to see such big deals in issuance. Okay. So today we saw quite a few deals, European deals. All of them were $500 million or less. Okay. We saw no sort of implications, cash flow implications this afternoon. Okay. Reg did point it out, and I'm glad he pointed it out. But be aware, guys, because you could be sitting there trading spreads, you could be sitting there trading outright, and you get caught in the most horrendous straight line move. Why? Because you're not switched on to cash flows. Remember, it doesn't matter what your levels are. Doesn't matter where you think buyers and sellers are. If someone comes in because he has to buy up the market for the next 20 prices because he's got to do a deal, he doesn't give a shit about the levels. All he cares about is getting the deal done. Got that? Don't forget that. Month of September. Excellent. Let's move on. Let's talk about love. Okay. Let's get to... okay, let's talk about the US 2-year. Very important you switch on here, guys. In fact, I'm going to show you something interesting. Wonderful chart. Oil copper, I tweeted this out. There's something significant about this market. Now, this is longer term, but what I want you guys to pay attention to, and the reason I'm showing this again, how many of you think the China slowdown began 2-3 months ago? Okay, so you're all actually quite switched on. When do you think, anyone take a guess, when do you think the China slowdown actually began? Anyone take a guess? When did the concerns about China begin? When did the government, the PBOC or the government of China come out and start to slowly but surely, lower their yearly forecast for growth?
Half a year. Half a year.
Half a year. Okay, how about if I told you Q1 2014? Almost 2 years ago. Q1 214, gentlemen. Now, why am I pointing it out? Because how many newspapers back in Q1 2014 were talking about the slowdown of China, the slowdown of the dragon of China, the driving engine of the world, China slowing down? And yet all I've read for 2 weeks now, 3 weeks, is China slowdown, recession, global recession, deflation, end of the world, everyone's collapsing, emerging markets are ending, the US is never going to hike interest rates. That's what we're being fed. Now, what I want to point out to you guys is that actually the slowdown in China began a long, long time ago. How do we know? Well, because it's simple. What is the best barometer for global demand? Commodity. Okay? If ever you want to get an indication of when there's a slowdown in the world, just look at the commodities. It's as simple as that. Right? Now, traditionally, most people tend to use copper as the best barometer because copper goes into every single building. And as we grow, as economies grow, copper rallies effectively. Oil's another good barometer, but probably not as good because it's not as widely used as copper is. And obviously, with technology changing, engines are becoming more cost productive and all that stuff. Now, what I've got here for you, in the purple line, we've got the wonderful copper price. Okay, in the orange line, we've got the oil price. And down below, what we have is the Chinese interest rates. Now, two things I want you to pay attention to. Okay, is one, that China's rate cutting cycle, note, over the last couple of years, and a rate cutting cycle, coincides with just after a slump in commodity prices. Okay, so for the last 3 cutting cycles, what we've effectively seen is a very strong downside move in the commodity space. However, what I do want to reiterate, okay, is that once the stimulus measures have been in place for a certain number of time, or the stimulus measures start to actually feed into the market, we tend to see a rebound, and potentially a rebound. Okay, so all I wanted to show you guys today is that don't read everything you believe. Okay, commodities have been selling off since Q3 of last year. Over 1 year ago, the commodities started collapsing. Not now. You can't start raising suddenly global fears of a collapse now, 1 year later, when they were slowing down a year ago already. Okay, because what you're doing is you're feeding the market information that already exists. Okay, price should already reflect the slowdown in China, not the other way around. So us as traders, us as investors need to be thinking, where to next? Where's the next opportunity? That's not priced. Okay. Now, what I want to show you lastly with regards to this chart. Okay. It seems as though looking at this chart that the oil market tends to be an early leading barometer for the copper. Okay. Now, the reason what got me to thinking about this was effectively, we've spoken about oil rallying 25% in the last 3 days. Yet copper has done nothing. More importantly, if you go look at the weekly copper charts, you're going to see a very aggressive engulfing candle in the copper to the upside. So I thought, well, heck, let me look at some of the commodities and see if something's going on here. And what I found out actually is that if you go back in the last couple of instances, you will find that the up moves and the down moves tend to be led by the oil price, with copper lagging somewhat. Okay. The most recent examples, obviously, right, is effectively we've got, so again, copper rallied very aggressively whilst oil had turned. Okay. Oil turned down the way, copper hung around, and then started to turn. Okay. And you can go through it throughout, guys. You see the oil turned there, okay, the copper took its time, was still rallying, and then turned. Okay. As the oil turned, copper still went sideways before joining in the fun. Right, now, obviously, this is a monthly chart, so you wouldn't have seen oil is somewhere back around here. Okay, so the oil has turned. What does that mean for copper prices? Well, in theory, they should go higher. Okay, so important, guys. I don't care if you make money out of this. That's not the point. It's not the purpose. I just want to get you guys away from reading what that price says, reading what the newspaper says, listening. Don't lend your ears too much. Pay attention to what price dictates, because price always leads everything else. If you understand that basic principle, that's the secret to trading, by the way. Okay? Understand the price. Don't be fooled by everything else. Okay. Let's move on. 2-year market in focus. Very important chart, guys. Sorry, I know I got a lot of things here very important today, but this is extremely important. Okay, what you're looking at here is the US 2-year. More importantly, what you're looking at is the weekly US 2-year dating back to 2011. Now, why do you think I'm showing you this? For one, okay, as you can see that in that period there for the last 3 years, all right, volatility's been very constricted, yields have barely moved, right? All of a sudden, if you compare it from that period to that period to that period, do you notice the difference in volatility? Okay, can you see how it's suddenly changed? Right now, the reason I'm pointing this out is because if you go back over the course of this year, you look at the beginning of the year, commodities showed the most volatility with oil shanking from 90 bucks all the way down to 37. Right, we then saw the great moves in the dollar space. We saw the euro dollar, the pound, everything open up doing 300-400 tick moves. The volatility picked up in the currency space. More recently, as of Black Monday last week and before, we saw 120 handle moves in the equity markets. So 5, 6, 7% moves in the equity markets. Right? There's one market left, guys, one piece of the puzzle that is yet to open up in terms of volatility. And that's the bonds. Okay, now, I just want you to be aware, because if the bonds start to open up, right, just be prepared not to fade the market, but trade markets as though they're volatile. Okay, now, this chart's important simply because at the 76 basis point, note the 2-year interest rate sensitive. All right, we've now had a 1, 2, 3, 4, 5, 6, 7 tests on a weekly chart at 76 basis points. If the volatility picks up and we take out 76 basis points, what's the one thing, this is yield, in terms of price, what's the one thing do we not want to be doing, guys?
No.
We don't want to fade the market. 100%. Long in terms of price, short in terms of yield. Okay, guys, if we get above 76 basis points, all you need to be thinking about as a trader is, how can I get on this trend? Let me not be afraid of this trend. Let me go with it because it's volatile. There's going to be a lot of people trying to fade it because they're not used to the volatility and they're not expecting the volatility. But us as traders prepare for these things. So when it comes, we're ready, we execute, we clean. That's our job, guys. Okay? Pay attention to 76 basis points. You'll probably hear me yell it when it hits that point or when it gets above it. More importantly, you'll probably hear me telling you, don't stand in the way, don't fade it. Okay? I want to open your eyes, guys. If I can get a chart and date back to you, the markets can, the 2-year bonds can very quickly move from 75 basis points to 100. I'm talking about in the space of 2 sessions, maybe 3. Okay, that will look catastrophic. It will sound catastrophic. But in the normalization process, it isn't, guys. Rates need to rise. Okay, because we need to rise towards normal levels. We're at abnormal levels right now. Keep that in the back of your mind. So, that's a very important chart. The last thing I want to point out in terms of all bond traders, spread traders, listen carefully. Okay, what you've got here depicted is a 10s 30 chart. Now, I've been banging on about this for a while. Remember, the entire market is expressing the forthcoming interest rate hike cycle in the US via flattener trades. Okay, so the whole market's positioned via flatness. What does that mean? In an up move, effectively, if bonds rally in terms of price, right, we draw a little grid. We know that 5s go the least, 10s go the second most, and 30s go the most. On the downside, okay, we know that 30s go the most, the downside, or sorry, in a steepener, 10s go the least, and 5s go the least. Okay, so what's being depicted here, guys, is effectively, if you look over the long run, as you can see, we've had flatteners for many, many years. That's been a long-term trend, guys. Okay? We then topped out of that trend earlier this year when we had the April sell-off in bond markets. And it topped out somewhere around the 80 basis points in the 10s, 30s. Now, what I want you to pay attention to is what occurs when we take out that 80 basis point level. More important, and this is the crucial crux of it, guys, we've been talking about the bond markets failing to rally whilst the equity markets sell off. Okay, we've been hammering on about that for a week and a half now. Now, why that is relevant is more important. Not only should bonds be rallying, but the bond curves should be flattening. What have we seen over the course of the last 2 weeks? Steepening. But don't tell anyone I told you that. Okay, because to the retail trader, to the small traders, they don't realize that something big's going on the underlying. The curve should not be steepening, guys. It should be flattening with the risk off. But it is steepening. Okay, that is a clue that you're never going to ever get again, guys. A steepening curve in a risk off environment is a screaming alarm bell. Okay. Now remember what I said to you. We're expecting the volatility to pick up in the bonds. It's the last piece of the puzzle. Okay. So just open your mind up in the next couple of days. If the bonds start to sell off, don't be surprised if they sell off very, very aggressively. Okay. But don't worry, it's not going to be the end of the world. Everything's going to be okay. Let's talk about gaps. Okay. First thing I'm going to point out. As we saw, we spoke about the Shanghai index, and we said the Shanghai index pattern was open with a gap, sell off, come back, retest, fail on the gap, have a second go lower, and kind of settle for the day. That was our pattern. Let's have a look what the Euro stocks did this morning. Okay, so again, on the open in the Euro stocks, Ooh, I think I might have gone too far. Okay, so the Euro stocks, note, it gapped. Okay. And by the way, very important, when I like to talk about these gaps, I don't like to talk about them in terms of the futures. I like to talk in terms of the cash. Okay, so note, there's the big gap in the Euro stocks. Okay, so at the cash open, somewhere around there, note the market. Okay, well, we gapped effectively. We tried to fill the gap. We failed to fill the gap. What did the Shanghai then do? The Shanghai then went lower. Okay, it then, let's scrunch this up a little bit. Okay. Right, the Shanghai then came back. Shanghai effectively tried to retest it a second time. Right, this one had a lower high before then, settling down on the day. Do you all see the similar pattern, guys? Market opens, tries to fill the gap, fails, then has a very aggressive push lower, comes up a second time, tries again before settling down. Okay, down 3% on the day. Have a look at the Shanghai. More importantly, guys, let's have a look what the E-mini S&Ps did. Okay, now I know I've shown you guys already, so I'm kind of cheating. You kind of know what to expect, yeah. Okay, but I need you to understand this. Okay, so again, note the gap. Don't like that gap. Let's get the US session. So effectively, the US session starts here, so you can see the huge gap in the US session. Okay, market opens over here. Market tries to fill the gap, fails, rotates lower, comes back a second time to fill the gap. All right, rotates lower. Okay, and now it's kind of just drifting. But what would we expect this S&P to do? At some point today, we would expect the S&P to have a little flush low before then coming back and settling down. Okay, similar patterns, guys. Now, the reason I'm pointing this out to you is because what I've noticed, particularly last week and all of this week, every single time there is a gap, okay, whether it's a range gap or a open close gap, okay, so open close on the futures, every time there is a gap, the European equities and the E-mini S&Ps tend to trade the same pattern. And that's what I was trying to point out to you today, guys. And what I'm going to do is I'm going to show you the video. Okay. Note, very importantly, note how I pointed out. I said the US equities are going to look to try and fill in the gap. Right? They'll then have a little pullback before going again, before then turning back over. Okay, so have a look. Make sure you look at the cash open of the European equities, DAX, Euro stocks, tomorrow morning, and then compare it to the US equity open at 2:30. See if you can find the similar patterns. If you're not too sure, go back to last week, compare the 2:30 to the 8 a.m. opens from last week, and you'll get a feeling for what I'm talking about. You'll get an understanding of how these patterns are replicating. So let's quickly look at the video, and we can finish off. So very important, I want you to note, there was buying 2 minutes before. Okay, the gap was all the way up somewhere at 50s. But what I want to point out, guys, don't watch too much into the trade. I just want you to see how the market responds on the cash open, because it's very similar in the Euro stocks. Okay, so this is about 2 minutes before. Note the buying. There was quite a bit of buy-side order going through just before the market. Okay, let's quickly fast forward this a little bit. Okay. Let's get the open done. Okay, so as you can see, market kind of just sitting around, holding a bit just before the open. Okay, and the market's opened. So let's see. Let's go back a few seconds. Okay, so market's open. As you can see, it goes nice and thin. Initially, we started 23.5s, and we've gone straight up to 26s. Okay, so we've gone to 26s. Now note what the market does. Very similar to the Euro stocks. It goes offered back first, Okay, so the market comes offered down to 24s. Someone sits there buying, 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 buying. Note once the absorption stops. Okay, so you can see 24.5, 24.5, note there, note there, note there. 24.5, someone's taking. 24.5, 24, 3/4, 25. Someone's buying up the market, buying up the market. Okay, so we can see that 24.5 is acting as good, strong support. Come down to 24s, come down to 23.5s. Okay, so we could see that buy at 24s all the way up to 24.5s. Right, let's see what happens now once the market goes back bid again. Okay, again, come all the way to 22s. So we started at 24s with the buy side, it's come all the way down to 22s. Someone tries to buy the market up. Okay, more important, let's see what happens when you get above the 24.5s. That was our key support the first time. Okay. You guys get a feeling for this. So, in terms of our pattern, what I wanted you to catch was market opened. It had to go up. It had a deep pullback. It then had a very aggressive second extension. Okay, if you see, we should take out these 27.5s in a minute, and the market should just catapult its way higher up the market. Okay. Make sure, guys, you look at the European equity opens, the first 5 minutes. Look at it in a 1-minute chart. Annotate it. Create the pattern in your head. Go and compare it to the US equity opens. Right? They've got very, very similar patterns at the moment. Okay. Very good opportunities to make a little bit of easier money on the opens. Okay, how long that exists for, nobody knows. Right. Let's finish off. So, we'll talk about iron reversal tomorrow once the US is done today. Again, what is your process-oriented goal? Right, make sure tomorrow you have a goal in mind. Make sure you achieve it. Okay, then the last thing. This is something all traders need. You need to stick this up somewhere in front of you. Okay, because it's probably the most relevant to us as traders. Right, because unfortunately as traders, there's always going to be this word. We're always limited as traders. We're limited to the time we can work. We're limited to the number of markets, the kind of size, the amount of stop we have. We're limited in so many ways. Okay, but listen to me carefully. The only way you will make it as a trader is to detach yourself from this belief that there are limits, because there isn't a limit. Okay, a limit is something we've had to create. Your risk managers have to create. Your boss has to create. They have to create limits to protect you, to protect themselves. But ultimately, guys, if you want to make a success in this, you've got to believe there are no limits. The limits is what you make it to be effectively. Okay. Good luck. Have a good afternoon.